I want to show you two people. Same age, same job, same salary. Person A opens one specific account at age 25, puts in $7,000 a year, never touches it. Person B thinks about opening it, waits until 35, then does the exact same thing. $7,000 a year. Same investments, same discipline. At age 65, Person A has $1,480,000. Tax-free. Person B has $735,000. Also tax-free. Same contributions, same strategy, same everything. The only difference? Person B waited 10 years to start. That 10-year wait cost them $745,000. That account, the one that turns waiting into $750,000 lost, is called a Roth IRA. I'm Felix, and most people watching this have never opened one. By the end of this video, you'll understand exactly why that's one of the most expensive mistakes you can make, and how to fix it today. Here's what we're covering. First, what a Roth IRA actually is. Not the textbook version, the real version. The one that explains why it's different from every other account. Second, the math of compound interest. Specifically your math, based on your age, right now. Third, the one mistake that kills the entire strategy. Most people who open a Roth IRA still make this mistake. It quietly destroys everything. And fourth, exactly how to open one. Which platform? Which investment inside it? How much to put in? Step by step. Let's go. Let's start with the problem that the Roth IRA solves. When you make money, the government takes a cut. You earn $1,000. You pay taxes. Maybe you keep $800. Then you invest that $800. It grows to $5,000 over 20 years. The government takes a cut of the growth too. Taxes twice. On the same money. Once when you earn it. Once when it grows. That's how a regular brokerage account works. That's how a traditional 401k works. Tax now, or tax later, but always tax. Here's what makes the Roth IRA different. You put in money you've already paid taxes on. You invest it. It grows. And when you retire, you pay zero taxes on any of it. Not on the contributions, not on the growth, not on the interest, not on the dividends. Zero. Completely tax-free. The government made this deal because they want you to save for retirement. So they said, pay your taxes now while your income is lower, and we'll never touch the growth again. For anyone under 40, this is almost certainly the best deal in personal finance. Now let's talk about the number from the opening. Why does waiting 10 years cost you $745,000? The answer is compound interest. Here's the simplest explanation I know. You invest $100. It earns 7% this year. Now you have 107. Next year, you earn 7% again, but not on 100. On 107, you earn interest on your interest. And the year after that, interest on a bigger number still. It doesn't feel like much at first. That's the trick. Compound interest is slow at the start, and then it's explosive at the end. Albert Einstein reportedly called it the eighth wonder of the world. He said, "He who understands it, earns it. He who doesn't, pays it." Let me show you what it looks like in real numbers. $7,000 invested at age 25, at 7% average annual return, becomes $113,000 by age 65. Not from contributing more, just from the original $7,000 sitting there for 40 years. One contribution, 40 years. $113,000. Now scale that up. $7,000 per year. Every year, from age 25 to 65. $1,480,000. Tax-free. You contributed $280,000 total. The remaining $1.2 million. That's compound interest. That's free money from time and patience. Now here's the gut punch. Start at 35 instead. Same everything. $7,000 a year. 7% return. $735,000. you lose $745,000. Not by doing anything wrong, not by making a bad investment, not by picking the wrong stocks, just by waiting. The cost of waiting 1 year to start, at age 25, is roughly $65,000 by retirement. 1 year, $65,000. That is what today costs if you don't act today. Now I need to stop here, because everything I just told you, the tax-free growth, the compound interest, the 1.48 million, none of it matters if you make one specific mistake. A mistake that most people make the day they open a Roth IRA. I'll get to it in a moment. First, let me explain who this account is actually for and how to know if you qualify. A Roth IRA is open to most Americans, but not everyone. Here are the rules. Simple version. You need earned income. That means money from a job, freelance work, side hustle, anything you pay income tax on. If you earned money this year, you can contribute. How much? In 2026, the limit is $7,000 if you're under 50, $8,600 if you're 50 or older. And here's the ceiling. If you're single and your income is under $153,000, you can contribute the full amount. That covers most people watching this. If your income is above $168,000, the direct route is closed. There's another path called a backdoor Roth. That's a separate video. For now, if you make under $153,000 as a single person, you're in. Open the account. One more rule that surprises people. You can contribute to a Roth IRA and a 401k at the same time. These are separate accounts, separate limits. They don't compete. If your employer offers a 401k, get the match first. That's free money. Always take free money first. Then open a Roth IRA. Max that out, $7,000. Then go back to the 401k if you have more to contribute. This sequence, 401k match, then Roth IRA, then more 401k, is what financial planners call the right order. Now, the mistake. Most people who open a Roth IRA deposit money into it and then stop. They think the account is investing. It is not. A Roth IRA is a container, like a bucket. Opening the account and putting money in is filling the bucket. But the money just sits there, in cash, earning almost nothing. You still have to choose what to invest in inside the bucket. I have spoken to people who opened a Roth IRA 3 years ago, deposited money every year, and watched it grow by less than 2%. Because they never invested. The money was just sitting in cash inside the account. They did everything right, except the one thing that matters most. This is the #1 Roth IRA mistake. An account full of uninvested cash is not a retirement account. It's a savings account with extra steps. So what should you invest in inside a Roth IRA? For most beginners, one fund. That's it. One fund. A total stock market index fund, or an S&P 500 index fund. We covered index funds in video 1. Quick recap for anyone new. An index fund owns a small piece of every major company in the United States. Apple, Microsoft, Amazon, Google, all 500 of them. When you buy an S&P 500 index fund inside your Roth IRA, you own a piece of the entire U.S. economy. Historically, over any 30-year period, the S&P 500 has never lost money. And you pay no taxes on any of the growth, because it's inside a Roth IRA. The 3 platforms most commonly recommended for beginners: Fidelity, Vanguard, Charles Schwab. All 3 are free to open. 0 account minimum. 0 commissions. Long established, federally regulated. Inside any of these, look for a fund called FXAIX at Fidelity, VFIAX at Vanguard, or SWPPX at Schwab. These are S&P 500 index funds. They are not exciting. They are not complicated. They have made a lot of people very wealthy by being exactly that. Not exciting, not complicated. Set it to automatically reinvest dividends. That switch is usually in the account settings. It means any earnings immediately go back in and start compounding. That's it. That is the whole strategy for most people in their 20s and 30s. You don't have to start with 7,000. The most important thing is starting. The second most important thing is making it automatic. If you can do $100 a month, do that. $100 a month from age 25 becomes around $262,000 by 65. At 7% average return, tax-free, $262,000 from $100 a month. From coffee money, from takeout money, from whatever you're spending on things you don't remember buying. Automate the contribution. Pick a date, the first of the month, payday, whatever. Set up a recurring transfer from your bank to the Roth IRA. Then forget about it. This is the part where most people overcomplicate it. They try to time the market. They wait for a dip. They read too many headlines. The data is clear on this. Automatic consistent contributions, regardless of market conditions, beat market timing almost every time. You are not smarter than the market. Nobody is. The strategy is consistency. The weapon is time. Let me give you your number. If you're 25 and you open a Roth IRA today and you invest $100 a month, you will have $262,000 at 65. If you invest $500 a month, $1.3 million. If you max it out at $7,000 a year, $1.48 million. All of it tax-free. If you're 30, same $100 a month, $185,000. If you're 35, $129,000. Every year you wait, the number shrinks. Not a little, a lot. This is not about becoming rich. This is about not being the person at 65 who did everything right, worked hard, saved money, lived reasonably, and still can't retire comfortably. Because they didn't know about this account. Because no one told them. I'm telling you now. You watched until the end. There's a number in your head right now. Your age. Your monthly amount. What that becomes. Maybe it's a good number. Maybe it's a number that stings a little because you realize you've been waiting. Both are useful. The math doesn't change. What changes is when you start. The best thing about a Roth IRA is that you can open one today. Not next month. Not after you figure out your budget. Today. It takes about 10 minutes and $30 to start. If this shifted something, if you're going to open that account this week, there's a button below this video. It means I can keep making these. And if you know someone who doesn't know about this account yet, that's who this video is for. Take care of yourself. This is educational content only and does not constitute financial advice. Always consult a qualified advisor before making investment decisions. Contribution limits and income thresholds are subject to change.